financial services, sale and lease of residential properties, importation and local supply of investment precious metals. For furnished lease rental, the annual value is used to compute the standard rated supply for non-residential properties. In terms of exempt supplies, GST will not need to be charged by the supplier at all. What are some of the common examples of financial services which are considered exempt supply? First, interest income from current or fixed account placed with a Singapore financial institution. This means that for individuals like myself, should I maintain a bank account with DBS or OCBC, a bank in Singapore, the interest income that I earn from my deposits will not be subject to GST on the basis that this is a form of exempt supply. Next, realized exchange gain and losses arising from transacting in foreign currencies. Provision of loan, advance, or credit to employees. However, one thing to note is if the exempt supplies are supplied to a person who belongs outside of Singapore, these supplies will be considered as qualifying for zero rating purposes. Next, we would like to further understand the concept of deemed supply. Deemed supply can be specifically found in the second schedule of the GST Act. The second schedule clarifies and deems a certain type of transaction as supply of goods or services. If you recall, we have earlier discussed that for a supply to be established, there is a need to identify an element of consideration. The idea of deemed supply is such that these are supply that exist even though there is no element of consideration. For example, in case of giving a gift to a third party, if you bought the gift in the course of business from a GST registered person, it will not be considered a deemed supply if the gift you are giving to the counterparty is not more than Singapore dollars 200. However, if the value of the gift is more than Singapore dollar 200, it will constitute a deemed supply for which you will need to account for GST. One very important area that I would like to highlight here is that for deemed supply, you are required to account for GST in your GST return. It does not mean that you need to really collect the GST from the person you're giving the gift to. Given that it's a gift, there is no monetary transaction. It is more common for companies to bear the GST cost by paying the GST to the Singapore Inland Revenue Authority out of its own pocket. Now, one other point to note is if you buy the gift in the course of business, but from a non-GST registered person, the gift to the third party is not a supply as no input tax was incurred. Right, now with that, we move on to the next segment on GST registration requirements. Let's go through the learning objectives. 1. Describe what are the circumstances and implications for an entity to register for GST. Explain the circumstances in which pre-incorporation and pre-registration input GST can be recovered. Outline the GST implication of group registration and divisional registration. Explain how and when a taxpayer can deregister for GST and the GST implications upon deregistration. Lastly, recognize the GST implications when there is a change in business constitution and ownership. First of all, we have to understand retrospective determination. Retrospective determination means trying to determine your GST liability based on the past transactions. So taxable turnover will be computed on a calendar year basis, typically for the purpose of determining registration liability. There is a need for business to monitor at the end of every calendar year and register for GST if your annual taxable turnover exceeds Singapore dollars 1 million. In the table below, in the event that you have determined that your taxable turnover exceeds Singapore 1 million for the period of 1st January to 31st December of 2024, your due date to apply for GST registration will be within a month of that determination, which is by 30th January 2025, and once registered, the effective date of your registration will be within 1 month, which is 1st March 2025. There, in addition to retrospective determination, you could also have prospective determination of your taxable supply. One must register for GST if there are reasonable grounds to believe that your taxable turnover in the next 12 months will be more than Singapore dollars 1 million. Typically, this is a situation that you enter into a sales contract or business agreement for the next year that has a value of more than Singapore dollars 1 million. Similarly, the registration has to be done within 30 days from the date on which you made a forecast that your taxable turnover for the next 12 months will be more than 1 million Singapore dollars. For example, if the date of forecast is 15 June, you are required to inform the controller of GST and complete registration within 1 month, and that is by 15 July. When a registration is not needed. Despite the compulsory registration requirements, if the person is certain that the taxable turnover for the next 12 months will not exceed 1 million Sing dollars due to their circumstances, he will not be liable for GST registration. This is provided if the taxable business can maintain documentary evidence to prove that the specified circumstances have occurred and detailed basis on how he came to the conclusion that his projected taxable turnover for the next 12 months will be 1 million Singapore dollars or less. What is a taxable turnover? Broadly, taxable turnover refers to your revenue that you would derive from operating your business and take into consideration all standard rated and zero rated supplies. However, it excludes exempt supply, out of scope supply, or any sale of capital assets, such as sale of equipment or any plant and machinery. Registration not needed. You can apply to the controller of GST from exemption from registration if you make or intend to make wholly or mainly zero rated supplies, even when your taxable turnover exceeds 1 million. So what is the definition of wholly and mainly zero rated supplies? This is when the company's proportion of zero rated supplies over taxable supplies exceeds 90% and would have been in a net refund position anyway had it been registered for GST. We have talked about the basis of GST registration. When is it compulsory? Under the Singapore GST rules, there are also situations where a company can voluntarily do its GST registration. This can happen even if the taxable supply is projected to be 1 million Singapore dollar or less in the next calendar 12 months and also past 12 months. However, there are some conditions that one have to satisfy in order to do voluntary GST registration. For voluntary GST registration, the company director, the sole proprietor, the partner, or trustee must complete 2 GST e-learning courses available on the IRAS website. It would be exempted if the company director, sole proprietor, or partner has the experience of managing other GST registered business, or if the company engages a person who is an accredited tax advisor or accredited tax practitioner to prepare their GST return, and that person has completed both e-learning courses within the last 2 years. The other requirements for voluntary registration includes the person must remain registered for at least 2 years. Meaning once you have been approved for GST registration, you are not allowed to deregister yourself for the next 2 years. In addition, the business must use GIRO for GST payment or refund, must certify that they will comply fully with the responsibilities of a GST registered business, and make taxable supplies within 2 years if it has not started making taxable supply at the point of applying for GST registration. In addition to the standard conditions above, the controller may also impose other conditions for the GST registration and will not hesitate to cancel GST registration of the business if the business failed to comply with any of the prescribed conditions. Now, we can also look at some other type of GST registration, namely group registration, where GST transactions of a group are to be accounted under a single GST return. This means that all the members are jointly and severally liable for any tax due. A single GST group registration number must be quoted by all members on the tax invoices. This is usually applied to a situation where there are a group of Singapore companies all to be registered for GST purposes. Instead of registering them individually, getting multiple registrations and returns, they could perform a group registration where one GST registration number and return is issued. On the flip side, we do have divisional GST registration, where the IRAS allows independent divisions within a company to secure different GST IDs and report GST separately. For divisional registration, it will not alter the liability or entity that's responsible to pay to the IRAS, meaning that if one of the division does not pay IRAS on a timely basis, the company would still be liable. The 1 million turnover registration limit also apply to the company itself and is not applied separately to each registered division. Exemption from GST registration, as mentioned, for companies making taxable supply who are wholly or mainly zero rated, they could apply to the Inland Revenue to seek exemption from GST registration. Claiming pre-registration GST incurred on goods. A company can claim the input tax in full if the goods are acquired within 6 months before the GST registration and are still held by the person at the time of GST registration. If the goods are acquired more than 6 months before the GST registration and the goods have not been consumed or supplied by the person before the GST registration. For pre-registration, GST incurred on property, rental, utilities, and services, input tax can be claimed in full if the property, rental, utilities, and services are supplied to the person within 6 months before the GST registration and are not directly attributable to supplies made by the person before the GST registration. Next, we'll look at the learning outcome for the computation of GST liabilities. In the next few slides, you would recognize the tax point under the time of supply rules where goods and services are supplied, apply the principles regarding the valuation of supplies, including imports, recognize the circumstances in which input GST is claimable and non-claimable, such as block input tax, explain the GST implications of partial exemption for partially exempt business, including the de minimis rule, compute the available GST relief, recognize the GST treatment for fringe benefit and for reimbursements and disbursements. Claiming GST. The generally rule to conditions to claim GST requires it to be incurred in the furtherance of your taxable supply and not block GST under Regulation 26 or 27. And if all are satisfied, you can move on to claim your GST. You would also need to establish if your GST are considered to be associated with a reimbursement or disbursement. So this has to be understood within the concept of the expenses being incurred. If you are incurring the expense in your capacity as the principal, the recovery of that expense is considered a reimbursement. However, if you are incurring the expense in your capacity as an agent, then the recovery of that expense is called disbursement. So there is a different GST treatment in terms of reimbursement and disbursement. For a principal, a reimbursement constitutes recovery of expense from another party that may be considered a supply and be subject to the GST as the case may prescribe. For an agent, the recovery of expense does not constitute a supply, and therefore GST will not need to be considered. As for the input tax claim, you are entitled to claim the input tax subject to regulations 26 and 27 incurred on the goods and services you procured in your capacity as the principal if the subsequent recovery of such expense constitute a taxable supply, and that is with effect from 31st May 2013. However, in the capacity of an agent, you are not entitled to any input tax claim on the expenses you incur, as the goods or services are not supplied to you, but to your principal instead. We'll now look at the place of supply. Place of supply is determined by Section 15.3 of the Goods and Services Tax Act. The supplier of services shall be treated as belonging in the country based on the following criteria. 1. The supplier has an establishment in the country and no such establishment elsewhere. 2. The supplier has no such establishment in any country, but its usual place of residence is in the country. 3. The supplier has such establishments both in that country and somewhere else, and the establishment which is most directly connected with the supplier is in that country. The importance of determining whether the supplier of service will belong in a country is important from a GST perspective. This is because it will directly impact your determination of the place of supply. Now, let's look at some practical example to understand the place of supply concept. If you walk into a McDonald's in Singapore, it will be established that McDonald's Singapore has an establishment in Singapore, and of course, there are such establishments elsewhere. But because of the fact that it's established in Singapore and most directly concerned with the supply that's being made, which is to you, because you are walking into McDonald's Singapore to purchase a McDonald's meal. In this case itself, McDonald's Singapore would be determined to have made the supply in Singapore, and the place of supply would be Singapore. This is true for most cases, especially as you read about examples where it involves a retail store in Singapore. The line is blurred when we talk about digital goods and services, and therefore, when you encounter situations involving intangible, such as services delivered across the internet, you have to apply these three rules very, very carefully in order to determine if the supply of such intangible services would be deemed to have taken place by a supplier belonging to Singapore. The implications would of course be clear. If the supplier of the service does not belong to Singapore, there will not be any Singapore GST obligations with respect to that supply being made to you. Next, we are going to talk about time of supply. Time of supply is critical for the supplier of the services involved. This is because the time of supply will directly impact which return does the supplier include the GST that is being charged on for filing to the Singapore Inland Revenue. The wrong determination on the time of supply would lead to the late filing and reporting of the applicable GST, which is subject to penalty. So looking at the time of supply, the general rule to remember is it has to be the earlier of the issuance of a tax invoice or payment received. Borrowing on the concept of consideration, it is important to note here that the payment that is being defined here does not only mean cash payment, it could be anything that constitutes a consideration for the supply being made. For example, if you have agreed to trade your sofa set for a computer, okay, assuming that you are in the business of selling sofa and you are GST registered, this barter trade between you and the other party will also be considered a taxable transaction, and the payment in this case is the computer set that you will receive. Therefore, in applying the earlier concept, you will note that we need to then account for GST either the earlier of you issuing a tax invoice to the other party, or where you actually receive the computer set, which is in this case the payment in kind that you are to receive for the sofa set you have sold or supplied. Now, it is important to determine when should the GST be accounted for, as I mentioned earlier, especially in a situation that it spans across 2 filing periods. Now, we'll look at a very simple scenario that is being discussed here. In a case that you receive a payment on April 30th, but you issue your tax invoice on May 1st. The question here is, when should GST be accounted for? Applying the rule, you will get to the right answer of the earlier of payment received or issuance of tax invoice. Therefore, given that the payment was received on April 30th, you will account for the applicable GST on April 30th. So next, what if it spans across 2 different months? For example, if we say that the payment is received on March 31st, 2025, but the tax invoice was issued on April 1st. Now, the correct answer is then the earlier of the payment date, which is March 31st. However, in this example that I've just shared, you will notice that it will actually differ in the period that you filed the GST. If you determine it to be on the March 31st, it will be included in your Q1 filing due on April 30th. If you have determined it to be on April 1st instead, it would have been included in your Q2 filing due July 31st. Therefore, it is very important to ensure that during the period where the month spans across 2 different filing quarters, you get the time of supply correct to ensure that you are properly and timely accounting for GST. Value of supply. Lastly, after we have considered the place of supply, the time of supply, we also need to understand the value of supply. So value of supply in general refers to the quantum of the transaction that is subject to GST. The concept is generally straightforward, because if I go to a store and I buy a McDonald's meal for $100, that is the value of supply. My GST on 9% is $9. Now, things become more complicated and gray when there is some kind of trade-in or non-monetary consideration. For example, employees benefit like food and accommodation, or, as I mentioned earlier, in the example, trading a sofa set for a computer. Now, for non-monetary consideration, there is a need to ascertain the consideration's open market value. For example, if I'm trading a sofa set for a computer, you have to then determine what's the open market value of your sofa set, and that will be the value you need to report for GST purposes. So for example, if you have a situation where you have to pay parts in kind and parts in cash, you will need to aggregate the 2 components together to find out the total value of the supply. I would also like to call out a very specific situation, which is GST to be paid on importation. For imports, GST is computed based on the cost, insurance, and freight value of imported goods, plus all duties payable to Singapore Customs. This is very important, as you need to understand that not only the declared value of the goods is subject to GST, the total value includes the cost of the goods declared at the customs, the insurance and freight value of the imports, as well as, if applicable, any custom duties payable. Once you aggregate everything together, adding on a 9%, that will be the GST that is applicable and payable at the Singapore Customs. It is also critical to note that the difference in paying GST for importation is that the GST has to be paid to the Singapore Customs at the time that the goods enter into Singapore. Otherwise, the goods will not be allowed clearance to be imported into Singapore. GST in the context of charities. So we talk about deemed supplies. One thing that comes to mind is, what about charity? So here I would like to introduce the concept of no strings attached donations. So when a charity or non-profit organization receives grants, donations, and sponsorship freely from donors and does not provide benefits in return to the donors, the grants, donations, and sponsorship received will not attract GST. Consequently, there is no need to account for GST on the grants, donation, and sponsorship. So under our legislation, certain donations to registered charities or institutions of a public character are deemed to be pure donations, notwithstanding there is a benefit given in return for the donation, such as the additional tax deduction granted by the relevant Income Tax Act. The recipient of the donation need not account for GST. To qualify for the concessionary tax treatment, the benefits must be treated as having no commercial value, i.e. no resale value, and is given in acknowledgement to the donation. A good example will be when you donate to an institute of public character, you may receive a trophy or a plaque in return to appreciate your donation. For such items, it will be deemed as no benefit being provided, especially if it's made to registered charities or institutions of a public character. And specifically, any tax deduction that you received as a result of your qualifying cash donation to institution of a public character, IPC, should also not be considered a benefit for charities. Therefore, no GST needs to be accounted for by either party. Next, we move on to consider what are the general rules for claiming input tax. In order to claim input tax, first of all, you must establish that there is a supply of goods or services made to or imported by the person claiming the input tax, and the person must, of course, be GST registered. Input tax must be paid for the supplies of goods and services used or to be used for the purpose of any business carried on or to be carried on by the person claiming the input tax. This is a very important requirement because if you are acquiring supplies that are not associated with your purpose or is not associated with any taxable supply provided by you, you should not be claiming the input tax. Input tax is attributable to the making of taxable supplies or out-of-scope supplies which would be taxable if made in Singapore or other approved supplies. Now, this is another important factor which says that if you are a registered business making taxable supplies, you will be able to claim the attributable input tax. Even if you make out-of-scope supplies, if such supplies, if made in Singapore, would be taxable, you are also entitled to claim the input tax. One type of supply that is not mentioned here and is specifically so for a reason are the exempt supplies. Take note that for exempt supplies, you're not entitled to claim input tax credit. The business that is claiming the input tax must maintain valid tax invoices, simplified tax invoices, or relevant import permits to support the input tax claims. GST is on a self-assessment basis, meaning you will self-assess and file your GST returns. The Inland Revenue Authority of Singapore may, on a random basis, select your company for an audit should they decide to do so. Lastly, input tax claims must not be considered block expenses under Regulations 26 and 27 of the GST General Regulations. This is very similar for those of you who have covered the corporate tax module, where we talk about corporate tax deduction. The general deduction rule is it must be incurred in the production of taxable income and not capital in nature, and not specifically prohibited under Section 15. This is the equivalent of the income tax rule, where there are certain input tax that are denied specifically under Regulations 26 and 27 of the GST General Regulations. Some examples of the disallowed input tax are, all these can be found in Regulations 26 and 27 of the GST General Regulations. Club subscription fees, for example, if you're being charged GST for Singapore Island Country Club payments, you cannot claim the input tax. Medical and accident insurance premiums, medical expense unless mandated by law or union agreement, benefits provided to family members, relatives of your staff, cost and running expenses of private registered motor cars, expenses incurred on company cars of which the Certificate of Entitlement, also known as COE, has been renewed or extended on or after 1st April 1998, expenses incurred on rental cars hired, any transaction involving betting, sweepstakes, lotteries, fruit machines, or games of chance. It is critical that you familiarize yourself with this general disallowed input tax to ensure that you do not claim them in the GST returns. Next, we move on to consider bad debt relief. When a trade debt is written off as a bad debt, the supplier may apply for bad debt relief for return of the output tax previously accounted for and paid. Supply goods and services for consideration in money and have accounted for and paid GST on the supply. You write off the whole or any part of the consideration for the supply as a bad debt. A period of 12 months beginning the date of supply has elapsed, or the debtor has become insolvent before the period of 12 months have elapsed. Taken reasonable steps to recover the debts. Value of the supply is equal to or less than its open market value. Ownership of goods, if applicable, must be transferred to your customer. Bad debt report as increased input tax. Recovery report as increased output tax. So it is critical that in order to claim bad debt relief for output tax previously paid, you must have taken the above steps and in general, able to explain to the Inland Revenue that you have undertaken sufficient effort to recover those debts. This is particularly important, especially if you're not able to determine that the debtor has become insolvent, as well as related party transactions. Practically, assuming that the debtor is unrelated to you, you should be able to claim the bad debt relief on the output tax previously paid, typically after a period of 12 months have lapsed, especially if you could not provide concrete proof that the debtor has become insolvent. Lastly, it is also critical to ensure that you are able to support that the ownership of the goods, if there's a supply of goods, have been transferred to your customer. This is to ensure that the IRAS is comfortable that you did not recover the goods and subsequently resold them, therefore allowing you to write off the bad debt that you are unable to collect from that particular customer. Next, we'll move on to cover supply of land and building. The sale or lease of all non-residential properties, including land and buildings, are subject to GST. Sale or lease of residential properties is exempted under the 4th schedule of the GST Act. Residential properties include vacant residential land, buildings, flats, or tenements, referred to as buildings. Residential land refers to vacant land that is zoned residential or rural center and settlement in the master plan that will be used for residential development. Residential building refers to residential dwellings, example, flats, semi-detached houses, and properties which are used or to be used principally for residential purposes to provide medium to long-term accommodation as alternatives to resident dwellings, such as service apartments. Now, what are the GST implications for business making exempt supplies? The general rule is that input tax is only claimable if it's applicable to the making of taxable supplies, standard or zero rated. For out-of-scope supplies, the general rule is that you should be able to claim the input tax provided that such supply, if it becomes a taxable supply, should be standard rated or zero rated. Therefore, if your business is in the exempt supply category, you would not be able to claim any input tax. The complication comes when you have a partially exempt business, meaning you do make taxable supply and you also make exempt supply. Strictly speaking, we should not be able to claim any of its input tax, as input tax attributable to the making of exempt supplies cannot be claimed. However, the business is allowed to claim all its input tax, including input tax attributable to the making of exempt supplies, provided that at the end of any prescribed accounting period, if the company satisfies the de minimis rule under Regulation 28, or it makes only Regulation 33 exempt supplies and is not a Regulation 34 business. So what does all this mean for a company? First, you need to establish whether the company is in the business of making exempt supplies. If the answer is no, then there is no concern about this rule. If you are a business that makes only exempt supplies, again, you stop here, you cannot claim any of the input tax credits. Then you have this category where a business that makes both exempt supplies and taxable supplies. There are rules that allow you to claim all your input tax, provided that you meet either one of the two conditions set out in this slide. If the de minimis rule is not satisfied in any prescribed accounting period, businesses may only claim input tax incurred in the making of taxable supplies only. Input tax that cannot be directly identified as incurred in the making of either taxable or exempt supplies is considered residual in nature and has to be apportioned. This is known as input tax apportionment. So, for example, if you imported goods that are subsequently resold and considered a taxable supply, all the GST you paid for importation of the goods can be claimed. Now, if you're talking about, let's say, rental, you paid GST on rental of office space for both your exempt business as well as your taxable supply business. In this case, we consider them as input tax that cannot be directly identified as incurred in the making of either taxable or exempt supplies, therefore known as residual in nature and subject to input tax apportionment. A little bit more about the de minimis rule, which is also known as Regulation 28. So under the Goods and Services General Regulation, it is stated that Regulation 28 is the de minimis rule that governs such a situation. If the business satisfies the de minimis rule, the business can claim all the input tax incurred, including input tax incurred in the making of exempt supplies. Kindly note that the input tax disallowed under Regulation 26 and 27 remain not claimable. So what is this de minimis rule that we have been talking about? The de minimis rule, also known as Regulation 28, states that it is satisfied when the total value of all exempt supplies made does not exceed an average of Singapore dollars 40,000 a month and 5% of the total value of all taxable and exempt supplies made in that period. So two things that candidates need to be aware of here. One, this is an end situation. And two, the first one requires you to take an average of 40,000 a month. Therefore, the two conditions that the company making exempt and taxable supplies would need to be considering would be, one, the exempt supplies value should not be more than 40,000 a month on average, which means annually it shouldn't be more than 480,000 and not more than 5% of the total value of taxable and exempt supplies. Meaning even if your exempt supply is below an average of 40,000 a month, if it is representing as half of the total supplies, both taxable and exempt, the de minimis rule will fail and you cannot claim all your input tax. However, failing the rule does not mean that you're not able to claim at all, but rather you will then have to apportion your input tax between the exempt and taxable supplies accordingly. Although the de minimis rule is satisfied in the prescribed accounting period, the same test has to be done again at the end of a longer period to determine whether all the input tax incurred in the making of exempt supplies in the longer period satisfies the de minimis rule. This is known as the longer period adjustment. Longer period is defined as the tax year of the business. Generally, it refers to the 12-month period commencing from either 1 April, 1 May, or 1 June, depending on the prescribed accounting period allocated. For example, if your prescribed accounting period is actually Jan to March, April to June, July to September, October to December, your tax year will be 1 April to 31st March of the next year. Accordingly, if your prescribed accounting period is Feb to April, May to July, August to October, November to Jan, the tax year will be taken as 1st May to 30th April of the next year. The failing of the minimis rule in any prescribed accounting period, like I said, does not mean that you will lose all your supply, rather your input tax associated with the supply. If you have failed the de minimis rule in any prescribed accounting period, but you passed the second de minimis rule using the tax year, you can still claim the input tax. Now, if you pass the de minimis rule in any prescribed accounting period, but fail the de minimis rule applied using the tax year, you may lose the input tax credit. Therefore, it is critical to understand that there needs to be two tests to be applied for the de minimis rule. Next, we'll talk about exempt supplies under Regulation 33. The exempt supplies listed under Regulation 33 of the Goods and Services Tax General Regulations, or what's commonly known as Regulation 33 exempt supplies, are considered to be necessary and integral to the making of taxable supplies. Therefore, conceptually, the Inland Revenue Authority of Singapore has allowed input tax incurred in the making of such exempt supplies to be treated as input tax attributable to the making of taxable supplies, subject to Regulation 34 and 35. Therefore, exempt supplies made under Regulation 33 are deemed as taxable supplies, and the corresponding impact is input tax associated with exempt supplies under Regulation 33 would be considered as qualifying input tax for the business making the supply. However, there are also other restrictions. Business is not allowed to claim input tax incurred in the making of Regulation 33 exempt supply if it is a Regulation 34 business, or it makes non-Regulation 33 exempt supplies and the value of non-Regulation 33 exempt supplies does not satisfy the Regulation 35 test. Example of Regulation 33 exempt supplies: 1 would be deposit of money, 2 would be receipt of interest in respect of provision of credit for any trade receivables. Regulation 34 businesses. Regulation 33 is not applicable to partially exempt businesses carrying on the business of or any business. Generally, any of the following listed below are considered Regulation 34 businesses, which mainly comprises of banks, insurance companies, and financial intermediaries. So what is the Regulation 35 test, which is basically the 5% test that we have referred to earlier? This is a condition that needs to be passed if the person making Regulation 33 exempt supply would like to claim its input tax. If the person is not a Regulation 34 business, but makes non-Regulation 33 exempt supplies, he can claim the input tax incurred in the making of Regulation 33 exempt supplies only if the value of the non-Regulation 33 exempt supplies, example, real exempt supplies, does not exceed 5% of the total value of all taxable and exempt supplies, both Regulation 33 and non-Regulation 33 exempt supplies made in the period. The person can claim the input tax attributable to Regulation 33 supplies. The same test will also be applied at the end of a longer period, which is at the end of the tax year, as previously discussed. Input tax apportionment. Similarly, as mentioned earlier, if you fail the de minimis rule, it does not mean that you get zero input tax. The following steps need to be undertaken. 1. You can still claim input tax directly attributable to the making of taxable supplies. This means that if you are a business that makes many different types of supplies, it is very important for you to isolate and identify input tax directly attributable to your taxable supplies. Outside of those, your input tax directly attributable to the making of Regulation 33 exempt supplies will also be claimable, assuming if you're not a Regulation 34 business and satisfy the Regulation 35 test. Otherwise, input tax attributable to the making of such exempt supplies is not claimable, and input tax directly attributable to the making of non-Regulation 33 exempt supplies is not claimable. We also have to consider the common input tax, or what we call residual input tax. Recall earlier, I raised one example of a residual input tax would be payment of GST on the office rental, which is used to make all kinds of supplies, exempt supplies, taxable supplies, non-regulation 33 exempt supplies. In the situation that you do not meet the rule, the residual input tax must be apportioned in the following prescribed manner. Non-regulation 34 business, and you satisfy the regulation 35 test, your recoverable residual input tax is actually your total residual input tax multiplied by the value of your taxable supplies and the value of your regulation 33 exempt supplies over your total supplies. Take note, your denominator is both your taxable supplies and the regulation 33 exempt supplies. Now, if you do not satisfy the regulation 35 tax, then the formula is slightly different. What would be recoverable residual input tax would actually be total input tax multiplied by just the value of your taxable supplies over the value of total supplies, meaning you will not be able to claim any apportionment associated with the exempt supplies if you are a non-regulated regulation 34 business and does not satisfy the regulation 35 test. Now let's go through a textbook example to try and put all that we have learned about de minimis rule into concept. ABC Private Limited make the following supplies in the prescribed accounting period of 1st April to 30th June. So they provided that you have this ABC Private Limited has standard rated supplies of 3,080,000, presumably Sing dollars, zero rated supplies of 1.8 million Sing dollars, exempt supplies of 120,000. The total value of the supply is 5 million Sing dollars. The question that's posed to us is, based on the fact pattern here, can the company claim GST incurred in the making of exempt supplies? Given that the question did not mention about regulation 33 exempt supplies, we can go ahead to assume that the exempt supplies are normal exempt supplies and not section regulation 33 exempt supplies. So first of all, we need to refer back to what we have learned earlier regarding the fundamentals of the de minimis rule. Under the de minimis rule, there are two conditions that you have to be able to meet together in order to make use of the de minimis rule, which then allows you not to exclude any input tax directly attributable to the exempt supplies and does not require you to make any apportionment under the residual input tax test. So during the exam, if such a question comes up, please remember to cite the following as well as the working as shown in the model solution. So first, you must call that you're applying the de minimis rule, despite the fact that it's not mentioned in the question. So when you apply the average of the exempt supplies per month, it will be 3-month period of 120,000, per month average will be 40,000. And when you compute the percentage of exempt supplies over total supplies, you use 120,000 divided by 5 million, and the percentage derived will be 2.4%. Therefore, considering the fact that the value of the exempt supplies on the average per month is less than 40,000 and it does not exceed 5% of the total supplies, the de minimis rule is satisfied and all input tax incurred for the making of exempt supplies can be claimed as input tax for the business. Hopefully, throughout the session, you have learned a thorough understanding to the basic operations of GST. With that, I would like to conclude with a big thank you. We have now concluded part 1, and we'll now move to part 2, where we will be discussing some questions to further reinforce your understanding of the Singapore GST rules.